Welcome to the deep dive. Today we are wading into some pretty high-level global statecraft because these political decisions, the ones being made between Washington and Beijing this week, they could genuinely be the single most critical macro variable affecting your crypto portfolio right now. Seriously. Okay, let's unpack this. We're seeing reports across The Guardian, AP News, basically confirming the US and China have reached some kind of preliminary consensus, like a framework for a high-stakes trade deal. And it's happening right before that big meeting everyone's watching between Trump and Xi. So our goal today, let's cut through all the geopolitical noise and figure out exactly why this potential handshake matters so much, specifically for crypto investors and traders.
Yeah, it's fascinating, isn't it? Just the speed of this potential shift. I mean, this deal, it's not happening in a vacuum. It comes after years of, well, pretty intense friction, right? Trade wars, economic mistrust, it's been building. So the fact that they're even talking about a framework, that suggests a real pivot, maybe away from just maximum tension towards, actual negotiation. And that fundamentally changes the whole baseline for global risk. When that mood shifts, crypto being maybe the most sensitive barometer of risk appetite out there, it feels that whip effect the strongest.
Right. And the specifics leaking out are pretty telling, too. China apparently agreeing to delay or maybe remove those export controls on rare earths, those critical tech elements.
Exactly.
Crucial stuff. And then the U.S. side is calling off, or at least hitting pause on, that they threatened a 100% tariff on a whole load of Chinese goods.
And that 100% tariff threat being effectively off the table, as the Treasury Secretary apparently confirmed. That's the immediate relief valve. That's the big tail risk, just vanish. Think of it like a huge uncertainty tax just being lifted from the global economy, going from this big escalation plan to suddenly hitting pause. That really sets a different tone for where capital might want to flow.
Okay, so let's dive right into that crypto connection then. I get the general risk-on idea, less global tension, people buy riskier stuff.
Yeah.
But why does easing friction in, like, traditional trade immediately hit volatile things like Bitcoin? And maybe even more interestingly, those layer ones, the DeFi tokens.
Well, it's maybe a bit more nuanced than just saying crypto is risk on. When you remove that big systemic geopolitical threat, institutional investors, they immediately start recalibrating. They see a macro tailwind forming. And that encourages two things pretty specific to crypto. First, yeah, institutions are just more willing to increase risk exposure generally. So you get these crossover flows. Traditional traders looking for growth, they might look harder at crypto now. But second, and maybe this is more important for those higher beta crypto assets, right? When there's a sudden rush of market liquidity, it often flows straight into venture, into innovation. So capital that was kind of sitting on the sidelines because of all the global uncertainty, now it's hunting for high growth. And that often translates directly into better funding for DeFi, for layer one ecosystems, for those big Web3 infrastructure plays.
That makes sense. So it's not just a quick price pump. It's potentially more fuel for the actual innovation happening underneath. Okay, but here's where, for me, it gets really interesting, especially for the decentralized infrastructure side of things. You mentioned rare earths, tariffs. How does this political framework directly touch the physical stuff, the hardware that makes crypto work?
Yeah, that's the supply chain connection. It's critical. If tariffs ease up, if export controls relax, particularly on high-tech components, that directly improves the whole pipeline for manufacturing tech. And what's absolutely essential for Web3 infrastructure to function and grow, mining hardware, right? ASICs, GPUs, all that specialized kit. We've definitely seen times in the past where hardware shortages, often driven by exactly this kind of geopolitical stuff and supply chain kinks, really choked the growth of mining operations or decentralized storage providers. So a relaxation here, it could mean lower hardware costs, maybe better availability, certainly fewer bottlenecks for those tokens that are really tied to physical infrastructure. It fundamentally improves the underlying economics of building these networks. That's way deeper than just watching the price chart.
Wow. Okay, so the token price could actually be reflecting the reduced physical strain on the network's foundation. That's a connection I think a lot of people miss. All right, let's pivot slightly. Our sources keep using this word framework. Frameworks sound good, but they can be kind of flimsy sometimes. What are the dangers here? What are sources like the Financial Times warning us to look out for in the fine print? What details should we really be watching?
Yeah, framework is the key word, and it raises that critical question. Is this real substance, or is it just political optics? We have to be skeptical here. The FT was pretty clear, wasn't it? That initial excitement needs to be tempered. We absolutely have to look hard at the final text whenever that appears. Is it just a cosmetic deal to make the Trump-Xi meeting look good, or does it have real binding commitments? teeth, basically. We need to see specifics, like does it spell out exactly how much agricultural stuff China has to buy and on what schedule? And crucially, are those deep-seated tech export limits genuinely being lifted or just kind of paused for a bit? The risk here is huge because remember, tariffs are paused, they're not gone forever. And while China's policy isn't always transparent, right? So any sign of backtracking or if negotiations break down later, boom, you could see risk aversion come roaring back, catching everyone off guard, crypto included.
Okay, I get the need to scrutinize the final text. But for most of us listening, we're not exactly going to be parsing trade agreement language, right? So what are the best proxy metrics? Things we can track outside the usual crypto charts that might signal if this framework is actually holding up or if it's starting to crumble.
Good question. There are definitely a few key things, both macro and micro. First, keep watching those core supply chain metrics we talked about. Yes, watch rare earth exports if you can find data. But also, look at semiconductor hardware shipments, especially stuff used for GPUs and mining gear. That's a really good proxy for the real health of that manufacturing pipeline and whether companies are actually investing in building out infrastructure, if shipments pick up smoothly. That suggests the deal's having a real-world effect.
Okay, supply chain health. What else?
Second, watch the crypto market itself, but look at the correlations. If the deal gets finalized, does Bitcoin's volatility drop? Does its correlation with, say, the S&P 500 change? Does it go up or down? A stable, maybe increasing correlation could suggest crypto's becoming more, normalized within the broader risk asset class. But if it suddenly decouples, that might mean internal market stuff is overriding the macro news.
Interesting. Correlations. Got it. And third?
And finally, your earliest warning system is probably on-chain metrics. You absolutely have to monitor exchange inflows and outflows, especially for the major tokens. Look closely in the immediate 24-48 hours after any final announcement. Is this macro relief actually sparking real, sustained buying by big players, accumulation? Or are we seeing net selling into the exchanges? The classic sell the news after the initial pop. That tells you whether the smart money really thinks the stability is going to last.
Right. Exchange flows as a sentiment gauge. That gives us a really practical toolkit for monitoring. Okay, so let's try and put this all together then for portfolio strategy. What does this actually mean for how you might position yourself? Can you walk us through those three potential outcomes, the scenarios based on whether this framework holds or not?
Yeah, absolutely. Thinking in scenarios is essential for managing risk here. So first, the bullish scenario. Let's say the deal gets finalized, it's implemented smoothly, no major hiccups, and it leads to a sustained global risk-on feeling. In that world, crypto inflows probably accelerate quite a bit. You've got less systemic risks and potentially improving hardware supply chains. That's a powerful mix. And in that specific scenario, I'd expect altcoins to potentially do really well, especially those infrastructure tokens, decentralized data projects, layer ones, the ones really dependent on network growth and physical tech. They could significantly outperform Bitcoin as money flows into higher beta growth plays.
Okay, that's the dream scenario for bulls. What about the middle path, the neutral scenario where maybe it's more political theater than real substance?
Yeah, right. That's probably quite likely too. The deal happens, but it's kind of basic, mostly symbolic. Enough for politicians to claim a win, but without deep, enforceable changes. Markets might take a quick breath, like, okay, the immediate danger is off the table, but there's no real new momentum. So crypto probably consolidates, trades sideways for a bit, and everyone's attention just shifts straight to the next big thing, maybe an interest rate decision or a key regulatory development. No panic, but no real party either.
Makes sense. Just a pause.
Yeah.
And then the flip side. What if the skeptics are right, the talks fall apart, and we hit that bearish scenario?
Yeah, that's the one you really need to brace for. If the framework collapses, maybe implementation stalls, or they just walk away, those threatened tariffs, they could come back online, like instantly. That would be a major shock to the system. Supply chains would tighten up again immediately. Capital would probably flood back into perceived safe havens. And crypto, being so volatile, it would likely get hit pretty hard, probably disproportionately as part of a big, broad sell-off in risk assets. Liquidity could dry up fast. You'd likely see traders pile back into cash or stablecoins until things calm down.
That paints a clear picture of the potential divergence. And it highlights the difference between trading and investing, right? For a short-term trader, this is maybe a catalyst to watch alongside charts and flows. But for someone investing long-term, how does the stability or lack of it change the core thinking about allocating to crypto?
That's a great point. For the long-term investor, it's really about systemic risk. If we get stable, predictable trade conditions between the US and China, that fundamentally lowers the overall systemic risk pulsing through the entire global financial system. That predictability makes holding crypto long-term as part of a diversified portfolio feel a bit more comfortable. Because the odds of some sudden massive macro shock completely derailing your multi-year accumulation plan, they go down. But if the deal fails, that systemic risk snaps right back. And maybe a more cautious wait-and-see approach makes sense until the global picture looks more stable again.
We've hit the price action, the hardware links. Nope, let's zoom out a bit more to the structure. Beyond just the cost of a GPU, does this kind of geopolitical thaw actually change the foundation of Web3 itself long term?
Oh, absolutely. I think it does. Now we need to think about utility, about regulation. If global trade smooths out, if those export controls really ease up, it just makes it easier for decentralized networks to operate globally without hitting constant roadblocks. Think about it. A stable global trade environment that supports the growth of all sorts of cross-border crypto applications, seamless capital flows, maybe decentralized identity systems, tokenized trade finance. Web3 might feel borderless, but its real-world adoption, that really depends on predictable, functioning physical supply chains and, crucially, stable legal environments. And there's another angle, too, the potential regulatory knock-on effects, maybe indirectly. If Washington and Beijing find some common ground on trade, does that free up bandwidth, maybe even political will, in the U.S. for regulators to finally provide some clarity for digital assets, without the extra headache of a global trade war hanging over everything? It's possible.
That's a fascinating point. And given China's role, as this tech and manufacturing giant, the potential impact in Asia must be huge, right? Even if direct crypto trading is still restricted there.
It's exactly. Huge potential. If China does ease certain export controls or maybe relaxes some internal tech restrictions, even if it's just for state-approved blockchain stuff initially, that could massively accelerate local blockchain research. And critically, it could boost the manufacturing and global export of that sophisticated mining hardware we talked about at scale. Stability like this could really unlock new investment flows into the whole crypto ecosystem across Asia, which, let's be honest, historically drives a ton of the retail interest and the technical innovation. When trade barriers come down, technology tends to flow more freely, and blockchain is definitely a technology.
That really ties it all together nicely. So the core takeaway here, it seems, is that geopolitics, global supply chains, they aren't just abstract background noise anymore. They're direct, kind of measurable factors driving crypto valuation and the actual development of the underlying infrastructure. This US-China framework, it's not just politics. It's like a crucial check on systemic risk that helps
Seriously, breaking down exactly why a potential trade deal over there matters to your Layer 1 tokens over here, it takes a lot of research, a lot of time. And honestly, the best way you can support us, help us keep bringing you this kind of timely, in-depth analysis. It's simple. Just subscribe if you haven't, maybe leave a comment, engage with the video. It sounds small, but your support genuinely boosts our visibility, helps the algorithm notice us, and lets us keep putting in the work to create this content for you. So thank you for listening, thank you for your support, and we will see you on the next deep dive.